Hello there, Maverick Traders. It is so nice to see you. This is Rob Reinhold. I'm joined by Darren Fisher, and here we are. We are in the third week of the month. That means it is monthly options expiration, so we're definitely going to be busy this week. Let's talk about what we're going to go through in this session. We're going to break down the last week. We're going to look at the news. We're going to look at the price action, and then we're going to see if our scorings have changed at all on the broad markets and sectors. We're going to go through the broad market, go through all the sectors, and we're going to make sure everyone knows what news is coming up next week. And then we're always looking for trading setups. And we're really focusing on the strongest sectors and the weakest sectors.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's break down what happened today.
All right, let's jump into last week's news. So last week we got another bit of a pullback. Not a huge pullback, but enough of a pullback to say it was definitely a down week. Most of the days were red candles this week. So we had the S&P close at or near its 50-day moving average and at or near the support of January and June of resistance points. So we're going to take a look at all these charts, but the S&P is still holding in. And I think you can look at the S&P and say, hey, you know what? I still feel like there is more upside. And then you look at the Qs and all of a sudden there's lots of problems with the Qs. We'll take a look at both of these charts and we'll talk about what we think is most likely to happen. This week after the Fitch downgrade, we got a week and a half ago, we got another downgrade. Now, this wasn't a downgrade. This was Moody's coming out and saying, hey, look, we're putting 10 major U.S. banks like JP Morgan, Wells Fargo, Citi, on alert for downgrade, meaning we don't like their credit conditions and we think we might have to downgrade their stocks. That has put more pressure on the market. So this market that just 2 weeks ago was flying high and it seemed nothing could stop it, Fitch came out, hit it, Moody's came out and hit it, and it's kind of feeling its punches. It's kind of wobbling a little bit like a boxer. The big question is, if there's another punch thrown, is this market going to go down? What do you think about that, Darren?
Yeah, there's nothing, you and I were talking beforehand, there's no economic event that we can see in the near future that would be the catalyst for a major market, a major trend change. But what I think you and I both discussed was that we're getting increased conditions for some sort of black swan event. Yeah, like one of these 10 banks that are put on downgrade alert. What if something leaks that, oh yeah, Moody's got it right, that didn't get it right enough, and they're in bigger trouble than what anybody thought. I mean, and that's just a supposition. That's the type of black swan event that conditions are being set up for. I don't know if it's going to be the banks. I don't know if it's going to be, ICE in Texas. Who knows what it is? But we're in that very touchy time, and we're already seeing some profit taking. And normal profit taking is fine, but this profit taking kind of looks like it's accelerated. Now we're at major support at the 50. I think something's going to give. Now, the only thing I'd say is beware the head fake. And we'll pull that up and we'll talk more about that when we talk to the markets. But this is going to be one of those times where I would be tightening up my positions, going for shorter term, not going for the unhedged long calls. I think that we're not at that point right now.
I think you're exactly right. And I think the analogy of a boxer is a good one, to where, just 2 weeks ago, the boxer was looking good, taking a couple punches, and now the boxer is a little bit on the ropes. Now, that does not mean the boxer is going to go down. It does not mean the boxer's over. But you do have to recognize that, okay, the boxer's got a little bit of wobbly knees right now. And yes, there could be another punch that eventually puts the boxer down. But if no punch comes, and as Darren said, then this boxer's probably going to stay on their feet. One of the other things I think could take this market down is a bond yield soaring. So So we closed at about 4.1819 on Friday. 4.2 has kind of been the ceiling. We've gone back to a couple times this year and a couple times last year. If we break out above 4.25, I think the market is going to have a really hard time rallying in front of the next move up to like 4.5, 4.75. So we talked about all the possible things that could hit the market. Let's talk about what happened this week. And this week was all about inflation. On Thursday, we got the CPI, and the CPI report came out great. Everyone was happy in the morning. The year-over-year number came down, and the markets were up like 1.5%. And then the bond markets shot up, and the market came down and lost all of its gain. Now, we have a saying at Maverick, and we use the term sentiment. And it's not the best word, but we can't think of anything else. Basically, if good news comes out and the market doesn't rally on it, it's telling you, hey, this market is either already priced it in, or it's tired, or it doesn't believe the news. And that's exactly what we saw happen on Thursday. Thursday's candle. If you talk to me in the morning, I'd be like, hey, there's the bull pullback. We're ready to go. By the end of the day, it was like, ooh, we're going lower. And that's exactly what Thursday's candle showed. We got the PPI on Friday that was hotter than expected, and that sent the market down. Ultimately, the market did recover some, but again, it's like that wobbly boxer analogy I've talked about. The markets are wobbling here, and we just have to see and wait and see where it's going to settle out. Before we jump into that, let's take a look at last week's trades. In the utility sector, we had a bear call spread on Southern, 65.70. This stock still has weeks to go before expiration, and you can see it had a little bear rally this week. Okay, had a nice little reversal, green candle. Lots of time on this one for sure. If yields do go higher, this one is highly likely to suffer from higher yields, being a bond proxy. Here we have Warner Brothers Discovery. Breakout above this 14. You can see it ran out of gas on the breakout, sunk back down. I had a diagonal call spread on this. So early in the week, I was looking mildly profitable. By the end of the week, I was looking mildly negative. Guess what? Mild is the key term. That's why we love diagonal call spreads, is because whatever happens, when it happens in the middle here, when all the price action happens in here, it's very moderate movement, and you can sit through a lot of volatility. It's only when it really gets outside of these areas that you're in trouble, and you can see there's nothing really to fear about this one on this little pullback. Next up is another diagonal call spread, U.S. Bank Corp. This one, and again, this is why we love these strategies. Look at this nasty candle. This was the Moody's downgrade. It gapped down, recovered all of its losses and more on Tuesday, and you can see we had a 40. We had I think it was a 37.40. This thing finished positive for the week. So this trade was profitable at the end of the week. I'm still holding the long calls. I'm going to be looking to diagonalize this again next week. We had a short-term short on Juniper, and this one was just a one-week trade, and it actually turned out to be max gain. So great job for those of you who followed on Juniper. And then Antero Resources, long in the energy sector. Wednesday had a nice gap higher all the way up to 29.50. And then we had some profit taking. Would have liked to have seen a better candle on Friday. This is definitely not a reversal candle. When it has a nice gain and then loses it all, closes down by its low, it probably tells you there's a little bit more to come down. 27 is going to be that support line. I don't see anything to worry about until it breaks at 27. So let's jump into the markets. Let's see if any scores have changed. First off, let's look at the numbers for the week. Dow was up. Dow was up, but it's such a small index. If it doesn't matter. S&P down 0.25%. The Qs down 1.5%. Russell down even more. Oil had an up week. Gold actually got hit really hard this week with the surging US dollar. The dollar had a good week this week because of those bonds. If it goes higher, the gold market is likely going to go even lower, since there is a negative correlation between the US dollar and gold. But let's take a look at the charts. Everything we've done up to this point has been cocktail talk. Just two guys with their opinions. That's nice, but guess what? That's not how we make trading decisions. So here we are on the S&P, and you can see we have been working our way down. Again, Fitch downgrade. And then we got Moody's. It's been putting pressure on this, but when you take a look at this on a technical basis, this is just a deep pullback to the 50. And when you see bull markets, you get some of these occasionally. You get a market that moves up, and what happens is that 20-day moving average usually stays a high, and then every so often it'll take that big dip down and frighten people out and meet that 50. And what typically happens is you get a pierce, freak everyone out, everyone panics, and then within a day or two, it's recovered back up above the 50-day moving average. I think that's what is likely going to happen to this market. Darren, what do you think about the pierce here?
I definitely think we're going to pierce. And there's two scenarios that I can see coming from that. Okay, pierce with a confirmation, because we've already got the pierce in the NASDAQ right there, but we've got a doji on Friday. So what does that want to tell you? Are we really at the bottom? I don't think so. I think NASDAQ's been leading this down. Earlier in the year, it pulled the S&P up. Now I think the second thing that's going to happen is the NASDAQ is going to pull the S&P down. So back to the pierce. We've already pierced right here. I want to look at Monday and Tuesday's candle. If we drop lower on the S&P and the Qs on Monday, I think that's going to be completely normal. Now, here's where the scenario changes. If we confirm with a lower candle on Tuesday, possibly Wednesday, then I think our downside becomes another 5%. The other option, though, is I don't think the markets have the gas in them right now to just do a normal bull pullback and then rebound and strive to make new highs. I think what happens is the other scenario that could happen is we base. If we base, that's going to be, if you're on the bullish side, if we base, that's going to be the best scenario for you, because you can allow time to catch up. You can allow people to catch their breath and then begin rebuilding other long positions that look pretty good. So if you're on the bullish side, that's great. If you want to be on the bearish side, you got to look for the pierce and the confirmation. I think that's where we're at right now.
And Darren, I think we are in about the same spot. Like worst case scenario, I agree with you, 5%. I don't see there being any more than that. There has to be some event that happens that we can't foresee to really push it lower. Economy's doing pretty good. Employment is really good. Wages are rising faster than inflation at this moment, which is really good for the consumer. I'm not saying that this is a great scenario by any means, but it is not where we were last March when we started our bear market. This is a decent time as far as economic growth goes. So I agree with you. If we do get the pierce, I think best case scenario, we recover very quickly. Worst case scenario, we go a little bit lower, but then that's really about it. So we just need to follow the charts. Here's the bond market chart. And I just want to show you, we did get a breakout of that 410 area. And here we are, 420 is really the area. I want to be worried until it gets above 425. That's the area where all of a sudden it's like, oh, we broke out of 4.2. 4.2 is held for over a year now. And if we break above that, people are going to say there's higher prices or higher yields to come in bonds, and that's going to put pressure on stock. So I think that's something you do want to watch this week. Watch that 10-year bond above 4.25. I think it's trouble. As Darren said, I think there's a major test early in the week. I think we probably get pushed down to below the 50-day moving average. There's probably a flush out. And the big question is, what happens after that flush out? Does it recover quickly? If it does, that's a very good sign for the bull market is still intact. If it does not, it's telling you that that run of the bull market is likely over. It doesn't mean a bear market starting, but it could lead into a sideways market for a while. Let's take a look at the schedule this week. Not a whole lot. On Tuesday, we've got retail sales and a manufacturing number. And then after that, there's really nothing all that important. I don't think the FOMC minutes are going to matter. So really, Tuesday is the only notable part of the week with good economic news. So here we sit. Here is our number. And we didn't decide this. We didn't sit down and have a discussion of whether we should be to zero. It's literally determined by the chart. We are below the 20-day moving average. We are above the 50-day moving average. And the slope of this 20-day moving average is now sloping down. This is sloping up. This market is a zero. Now, that being said, we don't think this is a sideways kind of market. And let me explain what I mean by that. Like, okay, when you have a zero market, sometimes you have a zero market because there's not a lot of volatility and there's not a lot of volume and it's pretty boring. And then sometimes you have a zero when it's a stop along the way. So if you were going from +3 to -3, there would be a stop at zero along the way. Or if you had a deep pullback from +3, you'd go down to zero before going back up to +2. So I don't like butterflies in this kind of market. I shouldn't say that. I don't like them as much. I think you still need to do some sideways positive theta stuff in this market, but I would back off on your positive theta stuff because I do think there is going to be a move based on where the market's going. So let's jump into the sectors and go through them one by one. Many people are unfamiliar with exactly what proprietary trading is. Prop trading is when a private firm hires traders like you to trade with their capital. Those traders are paid a percentage of the profits that they generate for the firm. Profitable traders are awarded higher and higher levels of capital to trade so they can take bigger positions and make more money. We've been in business for over 25 years and we're one of the oldest prop firms based in the USA. If you would like to look into being a trader for Maverick, look in the video description below and click on the trader position to apply.
Yeah, some kind of interesting movement in these sectors. And again, if the broad market is confusing you, throw it out. Put any chart you've printed into the shredder and then just go right to the sectors. You see energy is on just a tear. It's looking really good. It wasn't looking good earlier this year, but this is definitely where the capital is flowing into, up 3.5%. Healthcare, another good, up 2.5%. Everything else, I mean, you've got your staples here. I mean, utilities up 1%, real estate up 1%, industrials up 0.5%. I mean, those all are pretty good. Communication services kind of surprised. Communication services kind of surprised me. It was really flat for the week, despite all the movement that we had in tech, because a lot of times communication services and tech are very highly correlated. And there's some overlap in the ETFs in there as well. The tech down 2.5%. I think that's going to be the leader. I mean, you take a look at it, and it's mostly big cap tech. I think it's the top 10 tech firms, the big cap tech firms make up half the market cap of the NASDAQ. I think I just saw that the other day. So, it's one of those things where big cap tech sneezes, everybody else gets a cold. Okay, consumers down a little bit, materials were down, not a lot of movement in those. Let's go with individual charts. Okay, so you can see utilities. I was at a -2 last week. I'm at a -2 this week as well. It's just kind of at a low base. You're well below the 20, well below the 50. This type of base, I think it just holds out for a little bit, but I think that we're at major support right now. So the big question, utilities, can they keep the support for enough time for people to take a look, for enough time to pass for people to say, okay, some of these utilities are pretty beat down. The interest rate risk looks to be lessening. Okay, it's time to get in there and establish some new positions. And this is the one. If the bond prices, if the bond yields, if the bond yields get above 4.25, I think you're right, Rob. It's down, and I think utilities gets hit the hardest. I think that 64 level gets broken. Going to communication services, was it a +2 last week? Went a +1 this week. Okay, still bullish. Just kind of a nice high base right there, and not a lot of movement. But we don't have the velocity that we had 2 weeks ago when this looked to be up in the +2 area right now. So still mildly bullish on communication services. One of the better looking charts out there. Real estate, the -2 last week. I'm at -2 this week as well. Again, this looks a lot like utilities, just that low base right there. And again, same scenario happens. If interest rates get too onerous, then I think real estate does take that tumble right now. Looking over at industrials, industrials actually, yep, we were at 0 last week and we're at 0 this week as well. Again, just that base right between the 20 and the 50. This is a medium-term support, I'd say, and it's not looking bad. It's just nobody wants to short it, nobody wants to go long, so it's just a 0. I mean, this is, for all intents and purposes, dead money. Healthcare looked pretty good. Last week we were at a 0, and now we're at a +1. Despite, I mean, you can see Thursday's candle. I mean, even though we were up there, right there. Look at that long upper shadow. If so, you can tell that there was some selling, but it tried to get up there. But then you look at Fridays, and it looks pretty good. Now it hasn't pierced the top end of that shadow up there yet, but it looks pretty strong. So the only thing that bothers me about healthcare right now is the overhead resistance at that 136 level. So if we can break above that, I'm happy to go to a +2. Until then, I think it just floats up a little bit incrementally at a time. Financials have probably took the biggest hit. Last week we were at a +2. We're at a 0 right now. Just stuck between those moving averages. And you can see, you go back about 3 weeks and you can draw a trend channel that's just mildly sloping downwards. Now we're at support right now. So does it break or does it bounce? And that's it's a coin flip at this point. I think if the market, if we do get the piercing scenario that we talked about in the market analysis, then I think this does break that midterm support, but it doesn't go bearish yet. So I think this has some time to fall before it hits the 50-period moving average, and I think it holds. I actually think it would hold the 50, but right now I'm at a 0, and that 0's got a pretty wide range on it. Consumer last week we were at a +1, and we're at a 0 right now. Just kind of that choppy little base that we had sitting right above the 50 right there. So we're kind of on this cusp of what do we do? And again, it's the same scenario as some of the other sectors. Do we break or do we bounce? And this could go down another point or two, and I'd still keep it at a 0. It might drift up, quite possibly might drift up. I think the markets are going to have to pull the consumer up. I don't think the consumer sector is going to be able to pull the markets up. Looking at tech, we were at a 0 last week, and we're at a solid -2. Now, this is just completely technical. Take a look at Friday's doji. It looks just like the broad markets did. This one is, as I said, I think is going to lead the charge either in a basing or in a piercing movement. So this is one to take a look at. We're below June's support right now. Okay, we just broke it probably Thursday, and we're decisively below it right now. So is this going to be a head fake? It could be, but right now you've got to treat this as a -2. And materials last week were at a +1, and I'm at a firm 0 on this one. And again, I mean, you see that doji on Friday. And, I mean, this is looking. At this point, it's just a bull pullback. Okay, it's got a little bit of room to move. Materials, I think, in a down environment, I actually think materials is going to hold up pretty well. But right now, just looking at a 0 right now. And on to energy, I'm at a +3. We, despite what the market wanted to do, energy said, nope, hold my beer, watch this. And, just broke out of that high base that we had, made new gains. Look at Friday's candle, nothing but up all day. So this one, capital's going into energy. It looks like it's going to keep going into energy. People still see growth in that sector. I think that's what you've got to take a look at. Don't fight the trend. Don't fight the market. So everything, what looks the worst? Tech, real estate, and utilities, all in -2. Nothing in a -1. Materials, financials, and industrials at a 0. That's not to say there's not going to be any volatility in some of the issues in those sectors. Just technically, they are neither positive nor negative. Mildly bullish, healthcare, communication services, and consumer. And if you're looking for some bulls with some legs to run, I think you got to keep looking at energy. So let's take a look at a couple of trades.
Have you been trading in the markets for at least 2 years? Are you starting to see some decent progress? Is that progress so small because of your limited account size? Maverick Trading is a prop firm that provides capital to profitable traders. You trade a minimum $25,000 account and keep 70 to 80% of the profits. After 2 consecutive profitable months, you move to a $50,000 account. As you keep progressing, you will be able to trade 6- and 7-figure accounts. To learn more about trading for Maverick Trading, either click on the Apply card in the top left, click Apply at the end screen, or click the link in the description to watch our recruiting video that explains more about Maverick and prop trading. If you like what you see, apply for a position and meet with our recruiters. Are you our next trader?
In real estate, we're looking at Prologis, PLD. We're going to trade this one sideways. You can see for the past 6 months, it's just been on this wide range. Really, with 120 as the bottom, and then you've got probably 128 at the top, and maybe the 130 from July's action. But I'd say the true range is probably going to be in that 120 area. And so, what do you got in the middle? 125. How do you want to play that? Just do a September, August 125 calendar call spread. Okay, it's going to be a week-long trade. You're going to have the September 125s after this week, and then you can decide what to do with them right there. I would, if I'm going to get in this position on Monday, I'm probably not going to hold this trade more than a week because I don't want to have. I could. There's no other way for me to change out to hedge out that September 125. So it's just going to be looking at a 1-week trade in this. In healthcare, we're looking at AbbVie. Nice little bull pullback in AbbVie. You can see some upper shadows on Wednesday, Thursday, Friday, but hey, it still made some gains. So it pulled back. Had a really good day on Monday, Tuesday, and not so bad. But that trend is up. So you clearly can see that the bull pullback ended on Monday. I think there's still room to go. We broke out of the late July resistance that we had over there. So how do you want to play this? I'm going to go to the diagonals. All right. So I'm going to go long September 8th, and I'm going to short this next Friday's 155. So it's going to be 150, 155 diagonal call.
And next in the financial sector, I think this financial sector really held in well. Like, it had a big punch against it, and the sector didn't fall. So I'm looking to be, not bullish, but bullish to sideways. Really a +1 kind of trade. I've already got some trades in some of the banks that are doing okay. They're just hanging out. I'm in diagonals in those as well. So this is in the insurance industry group. This is MetLife, and just a really nice little bull pullback. You can see that we broke out of the high base. We ran up. We came back right to that base, and we bounced with a nice confirmation on Friday. So the only question is, how do you want to play it? I'm going to stick with diagonals, my +1 strategy, at 60-65. So you're basically saying, okay, I think that by the end of this week, it's going to be possibly somewhere around 65. Your risk graph is going to look like this. Probably somewhere down in the 62, 50, 63 area is going to be your break-even point. But as long as it hangs out up here, this is a good trade. And then on Friday, you get to decide what I want to do. Do I want to close the whole thing at a profit if it's right around 64, 65? Or if it's looking to break out of 65, do I want to let that option expire and hold my 60 call into the next week? There's lots of great things you can do with these diagonals, but for the first week, it starts out as a really wimpy +1 trade. The consumer sector, I think if the market does bounce, I think the consumer sector is one of the ones that is likely to go. However, if the market falls, I think the consumer sector is going to follow tech because it has been the third best performing sector behind tech, communication services. It's been consumer. And take a look at this trade here. I actually did this trade on Thursday in my end of day, and I talked about this is called the belly flop. Now, this belly flop pattern is not the actual name of it. It's what we call here at Maverick. But when you have a huge run in a stock, and then all of a sudden it has a drop from earnings, which we had right here. So a super strong stock that's had a huge gains. and then it drops off of an earnings report and it doesn't bounce. And what it does, it goes into this base. Now, I used to call these first stage downtrends. And we were meeting with the group live, and I said, hey, look, that's not a very cool name. Help me come up with a good name. And someone came up with the name of the belly flop, and I loved it. So I really like this one. Now, look, I'm not going to play this aggressively. If I did want to play it aggressively, I could, but I'm just going to play the 17-18 bear call spread. So yes, this thing could potentially drop pretty significantly. And if you think it is, maybe you go a little bit more aggressive. But for me, I am not going to be going that aggressive, and I'm just going to be going out 2 weeks to the August 25th expiry.
So in tech, looking at IoT, this is Samsara Incorporated. And this is what I love about screeners. I couldn't tell you any way, shape, or form, put a gun to my head, what Samsara does. And you know what? I don't care. I screen for my criteria. It comes up, and I get to trade names that I don't have to put on watch lists. So look at this one. It's just had a breakdown. It was in a long base, and then we broke down on Wednesday. Broke down Tuesday, got confirmation. And when you see something like this, people have just given up all sorts of faith in the stock right now. So best way to play this one, I mean, you're well below that support, that had been established over a period of a couple months. I think the best way to do this one is, pretty wimpy trade, but a 22-25 bear call spread with the September monthlies. Okay, look at the energy sector. And again, the energy sector was +3. I mean, this is looking good. Capital's moving into it. It looks like it doesn't want to move out. We're looking at NOV right now. And you can see it broke out of that high base. Candle didn't look too good on the breakout on Wednesday, but Thursday and Friday, both green candles, looking really good. So we're out here right at about the 2087. How do I want to play this? Hey, doesn't happen very often. I got a +3 sector where nothing wants to go down. I'm going to go out to those September 15th, 18 calls. We don't do unhedged calls very often, but this is one of those opportunities that I think is going to be worthwhile. Really nice delta play. You got minimal theta decay. I think that's the way you need to play it.
If you have any trades you want to share with the rest of the Maverick group, you guys know where to go. Log into the website, go to our forum, and we just love to see the discussion with all of our traders, sharing ideas and helping everyone out. Let's wrap this up. I think it's likely we see a Pierce early next week. So I'm thinking Monday, Tuesday is likely down, and we might get that little kind of panic to where people are starting to freak out. I think it's very short term. This is why we love option spreads. You are allowed to sit through these periods of freak out, and you don't have to do the freak out yourself. You've got everything position size for max loss. You've got some bulls, some bears. So if the market tanks, guess what? Your bears are going to do great. Your bulls are probably going to suffer. But you can sit through that volatility and let it come back up. But as Darren said, if it goes down and doesn't come back up, at some point we have to admit that was it. The boxer is down. The boxer has officially fallen down. And then we're going to have to revamp our outlook. But this is where bull markets go. There's always times in bull markets where they get this test. And sometimes they fail the test and sometimes they pass the test. We don't know what's going to happen this time. We can pontificate, but we don't know. So the best thing to do is be neutral, as close to neutral as you can. Be position size for max loss, so if any volatility comes in, you don't have to panic. And then a week or two from now, we probably have a more clear idea of what's going to happen. Because right now, we're to zero. And like I said, this isn't a sideways zero. This is we're either on our way to -2.0, or we're going to bounce back up to -2, or sorry, to +2. We don't know what it is, so I don't think you want to be putting on a lot of sideways stuff here, because I think in 2 weeks, the market is going to be at a much different place. So I think you just want to just tamp everything down, be cautious, and then when it is more clear, we can jump back on stuff. That is the trading room. Thank you for joining us. Goodbye, everybody.
Good trade, everyone.